Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of the video is how to set up a captive insurance company in US. So before discussing how to set up a captive insurance company, we will get through that how what is the concept of the captive insurance company is that what is basically a captive insurance company is called. A captive insurance company is a licensed and regulated insurance and reinsurance company owned by a non-insurance company for purpose or purposes of insuring or reinsuring the risk of its owner or owners affiliated companies. Creating a captive insurance company can provide an innovative solution to you risk financing needs and enhancing the financial and operational performance on your organization. But for business yet to run a captive, there is much to consider from understanding the feasibility of your captive and applying for it to understanding the roles and responsibilities of the board and other functions. You will also want to understand the annual reporting cycle and how to get the most value from your captive. This insight is based on 2023's June's Captive Owners Forum, which you can access by completing the form on this page, and covers the captive pre and post application and captive feasibility studies, captive application process, regulatory considerations, managing your captive day to day, annual cycles of captive board meetings, financial strategy, renewals, and optimizing your captive. Captive pre-application process and captive feasibility studies. A feasibility study is a crucial step in setting up your captive. It will help to define the projected cost of establishing the captive, the ongoing cost of operating it, and the wider financial commitment required. Key stakeholders will be involved in developing the feasibility study, with the major component being to understand the losses you are looking to address with the captive and the organizational risk appetite. You should determine both with collaboration across the business and using actuarial forecasting to examine factors included the expected per claim and per occurrence retention and the aggregate protection. So this work should also take in the level of confidence over losses, calling on your own or industry data. So the feasibility study will also assess expenses such as fronting fee charges by the insurer to provide all of the services involved with the program and to assume the credit, operational, regulatory, tax, and the legal risk. Other expenses you need to consider at this stage include excess insurance, reinsurance, claim administration cost, and general captive admin and management cost such as actuarial audit and the legal domicile fees and taxes. The final element to examine is the capital you will need to set up the captive, which will vary between domiciles, with your feasibility study assessing variations between domiciles. Further factors that influence the capital requirements include the lines of the business and level of risk you plan to your captive for. You should make financial projections on capital based on the different loss and the growth scenarios to make an informed decision as to whether to proceed with the captive and otherwise in light of this and all other considerations. So what is the captive application process? Regulatory considerations. If your organization goes ahead with setting up a captive, your captive advisors will help you navigate the regulatory applications and approval processes. The financial regulator of the jurisdiction where the captive is to be set up uh, will want to will want to know the key objectives for your captive, the lines of the businesses that will be hold within your captive. It will assess two key areas in the context: the financial strength of the shareholders and the robustness of the business plan, plus the way the company intends to operate it. In assessing financial strength of the shareholders, the regulators will carry out a detailed due diligence on the immediate parent undertaking, that is the company that directly owns a captive, and if applicable, the ultimate parent undertaking if the captive is indirectly and the ultimate beneficial owner of the ultimate parent company. The regulator assesses the robustness of the business plan, also known as scheme of operation, by analyzing it in the detail. Your business plan should specify a number of key areas, including 3-year business plan stress tested under pessimistic and the optimistic scenarios, 3-year capital calculations, overview of historical business if available, modus operandi of the insurance company, including details on the internal control system, draft outsource agreements, for example, the insurance management agreement if day-to-day running of the captive vehicles is to be handled by professional captive management managers, the details of any reinsurance agreement arrangement, then named members of the committee board and the terms of reference of the committee board. The regulators has the following number of predefined conditions to grant an insurance license to which your captive company will need to be abide, including the injection of share capital into the insurance company needing to operate in line with the business plan agreed, the submission of quarterly management accounts and returns. Although frequency might vary by the jurisdiction and the type of business underwritten, the submission of a copy of signed agreements within 1 month of the operation. So, in addition, any changes to the committee members, board directors, and shareholders will require regulatory approvals. In terms of timing, to establish a captive, this can vary depending on the type of the captive, ranging from 2 weeks to over 2 years to develop and execute the capital proposal. Managing your captive day to day, running your captive day to day will rely on the upon a system and the structure of governance. A typical arrangement might look like board members are likely to be executive directors affiliated to the parent company and independent executive directors, and both sets of members would have been named in the captive application process. So this role and the responsibilities of the board are to provide leadership, set strategic aims, values, and standards. The board has responsibility from day to day conduct oversight of the outsourced functions and must establish and maintain robust systems and the controls. Its responsibilities means the board of directors needs the necessary skills and the market knowledge on the business strategy, business models, and the governance. So board directors must also have the requisite financial and insurance expertise and the understand the regulatory framework and the requirements. Underwriters' roles and the responsibilities, including assisting in renewing policies or taking on a new risk, and liaising with the brokers, fronting issuers, and the actuaries. Underwriters are also responsible for producing monthly, quarterly underwriting accounts, monitoring premiums as well as unearned premium reserves, commissions, and the issuing policies. The claims function is concerned with the claim protocol for notification of an incident's claim to the board, receives the board reacts of the claims notified, that is a listing of claims outstanding and claims to be paid, accounting for claims paid, recoveries received, and the reserve movement, ensuring these have been correctly paid and reserved for processing claim payments, and the establish outstanding loss reserves, ensuring consistency with the agreed business plan. The financial and the regulatory reporting functions meanwhile is required to assist in the group forecast, budgets, and cash flow statements, then produce monthly, quarterly management accounts, maintain the bank accounts, effect payments, prepare reconciliation, produce annual statutory accounts, and manage the external audit process, work with other functions to complete all the regulatory reports. The compliance area is required to consider aspect of the compliance, including compliance with all regulatory findings. The risk management function should set out an annual risk management plan, assist the board in developing a risk management strategy and the framework, define the risk existing in specific area, develop written risk management policies and the procedures, as well as identify and assess new emerging risk. The risk management function must also prepare both the own risk and the solvency assessment, which is the board's assessment of the capital required to write the relevant lines of the risk, as well as internal and supervisory reports. So that was all about the introduction of the establishing a captive insurance company. Now we will discuss what are the basic steps, a 5 steps primer to set up a captive insurance company. So captives are used by the vast majority of the Fortune 500 companies to finance their own risk. In fact, there are approximately 7,000 captive insurance companies domiciled in more than 70 regulatory jurisdictions worldwide. A captive insurance company is set up to insure the risk of its owners, and it is an integral part of a good risk management program. Specifically, a captive insurance company is an insurance company that is wholly owned by and controlled by its insurer. Its primary purpose is to insure the risk of its owners, and its insurers benefit from the captive's insurer's underwriting profile. So this include pure captives, association captives, and the industrial insured captives. So find out what are the ways, the steps necessary to successfully establish captive insurance company in the following 5 step primer on setting up a captive. The first step is determine the likely captive structure. There are many different types of the captive insurers. So the first step in setting one up to is to determine which type of captive might be most suitable for your risk management needs. A number of different captive insurance company options are described below. Single parent captive. A single parent captive or pure captive is a separate legal entity formed as a subsidiary to a parent organization. The parent owns and controls the captive to ensure the risk of the parent company and its affiliates. Association captive. An association captive, also known as group captive, is formed by a group of individuals or the entities sharing homogeneous or heterogeneous risk that agrees to jointly own the captive to ensure the risk of the member owners. In some instances, an association may act as the sponsor of the captive to facilitate its information. So what is the risk retention group? A risk retention group is an insurance company formed and operated pursuant to the Federal Risk Retention Act of 1981, as amended in 1986, that allows the policyholders owned insurers to underwrite most type of liability risk under the primary regulatory authority of its state of domicile, without being encumbered and the non-domiciliary state licensing laws and the regulatory oversights. What is the agency captive? An agency captive is a captive insurance company established by an insurance agent or broker created to underwrite and insure a portion of the book of business that the agent and the broker writes, typically because the agent believes the book of the business will produce an underwriting profit and the agency is looking to expand its source of revenue. So 831b captive. The Tax Reform Act of 1986 created the 831b section of the Internal Revenue Code IRC, making it advantageous for small and mid-market companies to own their own insurance companies. An 831b captive is a captive that may be taxed under Internal Revenue Code 831b, which provides that the captive qualifying to be taxed as a US insurance company may pay tax on investment income only in any year that its written premium is at or below the threshold for applicable tax year, which in 2017 was set at 2.2 millions, and the less with the premium capital subject to inflation adjustment. Such captives are also known as micro captives. Rent a captive. Certain captive insurers, typically established by an insurance broker or a captive management company, can provide all of these services normally associated with a captive of other entities for a fee. Rent are captives and are an interim step for the organization interest in forming captive, but not looking to incur all of the frictional cost to initially set up their own captive insurers. So protected cell captives. This option involves a caption setting up a separate account cell or for each insured entity. These captives are similar in nature to rent a captive. However, in this arrangement, the cells isolate losses incurred by the insured party from all other entities involved in the captives. So, what are captive tax issues? Regardless the format you choose, there are three fundamental elements. One is the arrangement must involve the existence of insurance risk. The second is there need to be both risk shifting and the risk distribution. The third is captive exists to provide the insurance in its commonly expected sense. Second step is conduct a captive feasibility study. Once you determine which of the basic captive structure might best suits your risk management needs, the next step in the process is to conduct a captive feasibility study. A captive feasibility study is a study undertaken to determine whether a contemplated risk financing program is feasible for a particular organization or a group of organization. A proposal for a captive feasibility study should always begin by stating its scope and purpose. If the purpose is simplified to fulfill a requirement that a captive submit a feasibility study as a part of the application filling, the study will simply focus on what a regulator will need to review the assumptions used in the producing captives financial projections. The study becomes in essence a business plan with actuarial supports for the loss assumptions, a description of any reinsurance protection behind the captive, and an explanation of how the capital requirements of the selected domicile will be met. The step 3 is interview and retain a captive manager. While not all captives will operate using a captive manager, the vast majority do. A captive manager plays a key role in the formation, development, and overall success of the captive. A captive manager brings the following area of expertise to the table: accounting, actuarial, claims management, domiciliary and regulatory, investment management, pricing, and the underwriting and potentially tax. While the captive manager may not be an expert in all of these issues, it has established vendor and network in all these areas that can assist your organization in securing the right professional partnership. So, the step 4 is selecting a domicile. Equally important to the success of a captive insurance company is selecting the best domicile for the captive. There are now more than 70 captive domiciles worldwide. While all may not be an option for your captive, a good partnership with your regulators is extremely beneficial. Your captive manager should assist you with considering prospective captive domiciles. Key elements is to look for to include the following: political stability, enlightened regulations, access, sport services, and then cost. The fifth step is preparation and submission of a captive application. So, in the last step, we will discuss that once you have determined whether you want to domicile your captive, the final step in the process requires you to complete and submit an application and all the additional material to your chosen domicile. Your captive manager will assist you in the completion of the necessary materials. You will also need to provide the domicile with the evidence you have the necessary capital required for the captive in the form of suitable to the regulator. So the approvals typically can take 90 days or more. Although domiciles are becoming better at the streamlining this process, so to conclude, it is relatively easy to set up a captive insurance company by following these 5 steps. Of course, the process is likely to go much smoother and with fewer mistakes if it are competent captive professionals such as one of the captive.com sponsors. So that was all about the topic, where we learned how to establish a captive insurance company step by step, and we also discussed how the what is the captive insurance company actually is. So hope this will be beneficial for you. So do subscribe the channel for more beneficial videos in future.